We welcome all of you on the topic webinar number 119 on the topic accounting and valuation for ESOP cost. Today our speaker is Mr. Anurag Singal ji. Mr. Anurag Singal is having 15 years of experience with reputed companies like ITC, Tata Steel and Aditya Birla Group. He specializes in valuation, financial modeling, financial due diligence, and provides CFO services to startups, SMEs, and investors. He has been a guest faculty at various RVOs, valuation standard boards like ICAA, IMs, and B schools. We welcome you, Anurag Singal ji.
Good morning, Anurag ji. Welcome all. And before we start the session, I would like to announce that we at BB are very proud to host these webinars. And we are also coming out with another workshop in Bangalore on the 22nd and 23rd of August. And we hope that as you people have been giving us so much love and cooperation in these webinars, you will also attend those workshops, which will be conducted by some brilliant speakers and technicians who will develop key formulas and methodologies on complex securities as well as intangible valuations. The flyers and the link for the webinar for the workshop will be shared in the group shortly. Thank you all. Anurag ji, now all diocese to you, sir. Thank you.
Thank you, everyone. Thank you, Neeraj. Thank you, Ravichandran ji. So my topic for the day today is a very cliched one, ESOP valuation. And I think most of the people have really come across ESOP valuation in some form or the other. So now the question is that whereas from, if I were to look at that entire ESOP valuation map, what happens here is that just to set the context, out of let's say 100 people who do valuation, who are registered valuers, how many of you do you think will be able to do NAV method valuation?
Maybe almost everyone.
Almost everyone, right? They will sign reports under DCF. How many people out of 100 will be able to sign?
Almost all.
Almost everyone, right?
But the question will be how the peer review, how the report.
To make and sign. I mean, anyone can sign. I mean, that is not a problem. But to make and sign, how many people will do that? Means the concept of WACC, free cash flow to equity, free cash flow to the firm, levered cash flow, levered beta, unlevered beta, DLOM, DLOC, all of this. How many people do you think will be able to know it properly?
Yes, that is exactly little.
So that number should be some 80, 85 people should be able to do that out of 100.
Yes.
Right. Now, yeah, I had written this very recently and therefore just sharing it. And therefore, just to set the context for ESOP valuation, so that we understand that this will be a slightly a premium zone. So out of 100 people can handle NAV reports, right? Now,
Yes.
85 can handle discounted cash flow reports, understanding what it is. I mean, there will be a lot of people who can just sign it and all. That is a separate thing. Now, to really understand industry, sector, comparable company methods, adjusting for scale, etc. And 70 people should be able to do comparable company method. Now, in all of these, NAV, DCF, comparable company, in case these are big transactions, you have a Khaitan and company and HSBC, all of these involved big transactions, 1,000 crore rupees is the deal size. I think 50% of people will fall off because they will not be able to handle all that complexity in that world of valuation. Again, out of 100, to my mind, how many can handle ESOP? 50 people generally say yes to ESOP. Because it is in the world of startups, a lot of people give ESOPs, listed companies give ESOPs. So whether it is under guidance note, now in ESOP, the technicality is India's 102 and guidance note. When does what apply? Guidance note.
For India's companies where the listed companies in 102, for others, ICAP companies.
It is not just listed company. There can be an unlisted company also where India's 102 applies.
Correct.
What is the criteria?
Net worth 250 crores.
Net worth 250 crores. Correct. Otherwise, it is a guidance note. Is there any significant difference between Ind AS 102 and guidance note for accounting for share-based payments? In terms of methods, whether there is Ind AS 102 which is applied or guidance note for accounting for share-based payments, is there any difference between the two?
Accounting or valuation you're talking about?
In terms
Black
of the
Scholes man.
methods, disclosures, is there any, I mean, whether a client says Ind AS is applicable or whether he says guidance note is applicable, my net worth is not 250 crores, but I have granted n number of options. Do you think life changes? Black Scholes model will apply in both, or can you apply intrinsic value here? Will disclosures change? So we'll come to that. Now that same thing, out of 100 people, if you have an ESOP valuation where OPM backsolve method is to be applied and there is a big six which is to be handled as a stat auditor, how many people will be able to handle? Now, this number 15, do you think this is the right number? Out of 100 people, how many of them will be actually doing a valuation, ESOP valuation and handling a KPMG, Deloitte, a BDO? How many out of you would have handled such kind of assignments?
I have handled Anurag.
No, you have handled how many out of 100? How many would have handled?
I think you can say around 10 or 10 to 12 people max.
Exactly. So I have also therefore plotted 15 people will be one who will be able to handle that. And then yes, of course, further lower can handle purchase price allocations. And then some of them, only 4-5 in the country will be able to handle hedge effectiveness, CVA, DVA assessments, which are required in case of companies which have handled into forward contracts and all. So today we are trying to work in this zone where we are able to handle ESOP valuation under Ind AS 102 guidance note, as well as also try to see that, okay, what are the complexities that come in when there's a big four auditor which comes in, when there's an OPM backsolve method which is to be used, etc. So that is what is the challenge thing here that we will try to do. This was just to set the context. Okay. So I will start with my presentation, which I just jotted, and then we will try to see. Coincidentally, I had done exactly 3 months ago a similar seminar, a Saturday, where 100 people had come. Today the attendance is lower. So, okay. So ESOPs, so where do ESOPs come into picture? ESOPs come into picture in cases where there are companies which want to incentivize employees. That are always there. Now, the thing is that it is the, when do you do ESOP accounting? So there are 3 parts into the ESOP cycle. You grant an option, that option gets vested, and that option gets exercised. What is the trigger event for accounting?
Year end?
Grant.
Grant, vesting, exercise. What is
Grant.
the trigger event for accounting?
Grant.
Grant actually.
Grant. Subsequently, let's say if the company has raised another series. Okay. So will that require true up of the cost? So let's say today I have given ESOPs in my company at a valuation when my valuation was $100 million. Let's say tomorrow it becomes $200 million. Will I have to true up my accounting for my ESOPs, which I had done? A lot of people have that question.
No.
Because the ESOP has now become more valuable. So let's say the share price was 100 rupees. I gave an exercise price of 1 rupee. So it became an intrinsic value of 99 rupees. Now, before this year end, the company has further raised at 200 rupees per share. In that case, does the company get the value?
No, not for ESOP accounting. Whatever is the value at the date of grant.
That is there. Okay, so you are saying that if there is 100 and 200 also happens, if my exercise price is 1, I have accounted it 99 rupees intrinsic value. Even if it becomes 100, 200, 300, doesn't matter. Although these ESOPs have become more costly, more valuable to that extent, there'll be no true up for sure.
Yeah.
But actually, valuation needs to be done as on the date of grant. No, if a first scheme is already done in the month of say April, again if you go in the month of December, I think there will be
I'm
change in the
asking, I
values.
don't know.
No,
I am just learning valuation from you. So I'm just trying to understand what should happen. Because there is a often this confusion happens that in April 24 it was 100, then in April 25 it became 200. So now auditors are saying, "Ki boss, this is now 200. Will this cost should be true up, mark to market, no?" So are ESOPs mark to market? Means that is one question that a lot of people have. Will ESOPs be mark to market? No?
No.
No, in case of share appreciation rights,
Yes. In case of SAR, of course, it will be mark to market. But
Uh,
again,
then
there
the-
also the question is that is actually a liability. So that is not really governed. So there is no standard which really mentions about how do you account for share appreciation rights. And that is
yes.
not a very common thing also. But in case of ESOPs, let us be very clear about the fact that the trigger event is grant. That is the only event where the accounting has to happen. So whatever was the fair value as on the date of grant,
ECC निकला है.
only
Can you
that,
mute Mr. Pradeep?
yeah. So on the date of grant, whatever happens, that is the trigger event for us. That will be there. So when we do accounting, we have an ESOP, which is the topic for discussion for today, but we also have ESPS, you have SAR, and you've got phantom option. Now, phantom option is a very dicey thing. You really don't know whether it is on the right side of the company's hat, phantom options and all. But yeah, SAR and all, yes, there are companies which have accounted for SAR, but yeah.
What is the
So
difference between SAR and phantom option?
in phantom options, what happens is that you get the right to invest in the company at a future date at a particular lower value and all. So that is not really what happens. That is not really the right thing to do. Lot of startups, like there was this company which Karan's company, they used to offer, these phantom stocks options to small gullible investors or startups. Ultimately, the companies at MCA gave a notice and they were all left high and dry. I am not really remembering the name. This is a guy called Karan who had really brought this phantom options into the country, but now it's not really working. SAR is there. Employee stock option plan is there. Now in ESOP, again, I will not cover this, but there is also a separate series of things happening. If there is a trust which is created, in that case, what happens? Company transfers shares to the trust, and from the trust, they will go to the employee. Now there are different reasons why people do that, but because I don't have any practical experience in it, I will not be able to be an expert here. But there is so for example, there is one company which was saying that we want to purchase shares from the open market and make them part of ESOP. Because ESOP program, because the promoters are not willing to dilute. Now, if you do that, you cannot do it directly. You have to do it through a trust. Okay. Now here, this is very clear. Grant price, the price at which shares are offered to the employees. Can the grant price be variable?
Yes.
Exercise price can be variable. Grant price.
It's grant at which, basically that is the thing. Yeah. So at the grant, the price at which this is, so at that point of time, can the company have dual structure? So in that case, actually OPM backsolve comes into the picture. In case of OPM backsolve, what will happen is that you have a cap table where the recent funding happened for a CCPS. I have granted equity, which is of the lowest thing. So you have a benchmark, which is 1200 rupees per share of CCPS. What is the equivalent price for equity, that we don't know, and that is why we'll come to OPM backsolve. Vesting period, the period after which all options can be converted to shares. So for example, there is a 12-month cliff, and then it will be worked in 48 monthly installments. In that case, there is a 12-month cliff here, and then technically each of this is a separate grant. So for each grant, you should actually have 48 line items and try to do the accounting such that you are able to amortize the cost between the date of the grant and the date of the expected vesting. That is exactly what is graded vesting method. Practically, it is very difficult to do that because for every one grant, if you are able to make, you have to make 48 rows. Imagine if there are 50 employees, then it becomes 2400 rows. So practically, maybe you can do some adjustments along with the auditors if they agree. But that is what, therefore, the vesting period becomes of material importance. Another challenge which comes in one of the cases that we did for a company, there is something called accelerated vesting. What is accelerated vesting?
If milestones are achieved by the employee, then vesting will be different.
Correct. So example, there could be a milestone which could be achieved. So the grant letter says that boss, there is a 12-month cliff and a 48-month monthly if it is BAU, business as usual. But if there is an IPO event, then the employee will not want to wait for the next 60 months and then try to get this. In that case, there is accelerated vesting. In that case, what will be the T that you will you take in the T equals to what? Will it be on the basis of this 12 plus 48, or this accelerated vesting is on the basis of an IPO event? Then what will you do?
And as of the date of grant, we don't know when the IPO will come, correct?
But
As
there
of
is
the
a
date of the
condition in the
calculations.
agreement. Let's say the company has filed an DRHP or is in the process of filing a DRHP, or it has appointed merchant banker. There can be different scenarios. Appointment, passed a board resolution that it will file DRHP, appointment of merchant banker, filed DRHP, IPO has not yet come. There can be many companies which have filed DRHP. In that case, what will happen? How, and this is one question which I really had a tough time trying to understand and explain. How will you account for this condition in your T? Yes, anyone. If there is an IPO event, it will get vested immediately. Now, how do you actually do that IPO event thing? So it can be on the basis of management representation, or you can actually do a Monte Carlo simulation and try to see that, let's say if it's a furniture company wanting to go for an IPO, what is the probability that startups who have raised, let's say, pre-series at a particular point of time in the next 60 months, how many of them have actually gone for an IPO? So maybe then on that basis, you can do some extrapolation and try to say that, okay, this is the 23% probability that IPO will come within this point of time, and accelerated vesting can therefore be 23%. So ये एक to point है. This is something that needs to be understood. The price of paying, action of paying the price and converting, this is exercise. An exercise period is, now let's say the vesting has happened and no exercise has happened. As a valuer of the, or basically for the accounting for stock options, does that change life at all for you?
In the startups, we are seeing this more often because it's easy for them not to exercise, whatever reasons, because they have to pay exercise price. We have seen many open exercise cases.
Then in that case, does that change your cost?
No.
What will you take as T here? So basically, let's say it is 12-month cliff, 48-month monthly, plus it will remain alive for 10 years after the cliff, after the vesting. But if they exit, immediately gone. So in that case, what will you take as T again? Will be the question here, that the vesting period is 12 months, cliff, 48 months equal installments. But after that, this exercise period happens. So that exercise period can be up to 10 years. So you have to actually go for a min plus max by 2. So what you have to say is that, okay, on an average, if it is, let's say for the first tranche, it is 13 months. And the max will be 13 months plus 10 years by 2. And therefore, you can go for an average, which will be 5 years and 13 months. It is 6 years and 1 month. So it will be like that. Okay. So the method of valuation will be either Ind AS 102, ASC 718, and IFRS 2. So ASC 718 broadly is similar to Ind AS 102. There's not much of difference. There are two methods in Ind AS 102 does not provide for flexibility, that it talks only about graded vesting method. What will happen? And here, what you can do is that you can also go for an ASC 718, you can also go for SLN. You have an option, you can go for SLN, you can go for graded vesting. Where will I get more cost? Graded vesting or straight line method?
Straight line, no?
In straight line, what will happen? If there is a grant today, it will be amortized, but in based on the life of the option. But in graded vesting, what happens? The next year's options also 1/2 plus the next year's option also 1/3. So what will happen? It is like WDV method, you can say. It is straight line method. This is WDV. You get more in the initial years and that will get fallen. Here it will be uniformly throughout the year, throughout the life of the option. So what will happen is that sometimes clients, suppose if it's a US based client, they will want an SLN method because they want a lower charge. There are some clients which want a higher charge in case of ESOP also. So then they say, okay, give me graded vesting also, because it depends also. Now, for example, because of the ESOP cost, loss will come, loss will trigger impairment. Sometimes they want to do impairment, sometimes they don't want to do impairment because of that. Okay, now again, the fair value of the option. Now it is fair value. It will be accounted for either Black-Scholes, binomial, or Monte Carlo. Very simple. Black-Scholes, a lot of, means there is no mystery surrounding around Black-Scholes. There are a lot of calculators available online. The discussion is more around what are the options, etc. in this, which will be there. Binomial, that is, we will come slightly into it. I'll show you an Excel example, and MCS is also there. Very simple method is its intrinsic value. In intrinsic value, what happens? It is, I don't take the time value of money. I just simply say that stock price is 100 rupees, exercise price is 1 rupee, 99 rupees is the intrinsic value of the option multiplied by number of grants 50. So 4950 is my cost. This is the simplest method of accounting. But again, if it is guidance note also, the disclosure has to be again as per Black-Scholes method. And hence you have to do BSMs working.
Mr. Anurag, sorry to interrupt. One quick question. You said
Yes.
under what category can you use an SLN straight there?
If it's a US based company, ASC 718
If it is
applies.
a US, okay, but still, if you're preparing it under IFRS, you still have to go to graded, right?
IFRS 2, yes. IFRS 2 and Ind AS 102 are in sync. Only
You have
US
to go,
applies
okay.
this straight line method.
Straight line. Okay, got it. Thanks.
Anurag, one question here.
Hmm. Yes, please.
Anurag, if the company is not into Ind AS, they are following IGAP and they are only required to follow guidance note issued by ICI, then can we do only intrinsic value or should we do
Yeah.
BSM as well?
BSM is required for disclosure in the
Yeah.
guidance. But what will hit the PNL is just intrinsic value. They can do that, but still a lot of them still do for Black-Scholes method. See, actually in ESOP now there's a lot of gray areas. Different
This
companies,
difficulty
different
actually I have
auditors.
faced. So that's why I was asking. Even I was unable to get an answer for it.
Mr. Anurag,
Yes.
in this case, for IGAP, intrinsic value is market price on the grant date minus excess price. So this means we'll get a fair value of the share minus excess price. Does it become intrinsic value? Then ESOP value is not required for India's this IGAP companies.
Sorry, can you please repeat?
What I'm saying is intrinsic value is saying market price on grant date minus excess price. So market price fair value of the equity share as calculated as a DCF method is 100 rupees. Excess price is 15 rupees. 85 rupees is the intrinsic value.
Intrinsic value, yes.
So this, if that is the case, then why we require for a Black-Scholes model for ICAP companies? Whether is it required only for a disclosure purpose or will it have an impact on the accounting?
So if you actually do imply, so there are actually two parts of the valuation. One is intrinsic value.
Yeah.
And there's also this time value of money. Time value. What
Okay.
happens is that I am getting something which is worth 100 rupees, getting an option to do 15 today.
Yeah.
So effectively, it is an in the money option at 85. But this 15 rupees will be exercise price after 4 years.
Correct.
So it is more lucrative, no? Because if you have a particular volatility of the stock, let's say 20%, there is a very high chance that when you actually exercise the option, it will be worth 150 rupees. And
Okay.
hence minus 15 rupees, actually the option is worth 135, not just 85 rupees. So there'll be a 50 rupees appreciation also by the time you get the right to exercise the option. So
Sure.
from that perspective, the time value also gets factored in by the BSM when they apply all of that volatility and all. In many cases, you will see that there are startups which will say if my fair
So
value is 100.
One point. In this case, when I go for this counting, intrinsic value in my case is 85 rupees. When I use the BSA model, the 85 may become 70. That 70 needs to be considered for accounting purpose, no?
Where
Value
here
of the option.
it is, for example, 85. Because of this, it will become 120.
Yeah.
So 120 will be considered here in case you are applying BSM.
No, my question is, can we start at intrinsic value only? Then we have to do BSA model, identify either 120 or 70 rupees. So for a 102, as per this guidance note, what is the requirement? Because always some people, when we get the for valuation, they say, give me only fair value, we'll do just straight amortized. So,
That they
but
want. That fair value, if it is guidance note, you can simply give intrinsic value and just close it. You don't have to
is
go
that
for Black-Scholes model.
no,
Black-Scholes model is,
is that
yes,
sufficient as per our guidance note, or guidance note also requires the black source model we need to use?
in disclosure. So a lot of companies don't really bother so much. Small companies don't bother so much about disclosure. So that does not come into the picture so much.
Okay.
So it is like that. Now what happens therefore is that in intrinsic value, if fair market value is 100 and exercise price is 100, in that case there is zero cost, because what the startup says is that whatever is the latest price at which fundraise has happened, I am giving you the option. So now that there is no, but you are playing that, okay, this exercise price is now frozen for the next 4 years, and therefore there is a value, monetary value to it because of that. So that is where BSM will give a number, but intrinsic value will not give a number. Now there are three methods here. Black-Scholes model, what is the difference between European and American option?
American option has to be
Expiry
exercised on
time.
the particular
Expiry
day.
time. Yeah.
Expiry time, basically.
Yes.
European is at the end and
American can be at any point of time, right?
yeah,
Yes.
yeah.
So therefore you have to make events. This like this can happen, exercise, not exercise, not exercise, like that. You have to make this binomial trees. But if it is European style option, it is a simple Black-Scholes, which is better. So the complexity is simple time-based service conditions. These are suitable for non-market conditions, but offer greater. So, but fine. So binomial, not so much. Now, so therefore the question is, and Monte Carlo will be for complex awards. So for example, for one of the companies where you have performance stock options, there you cannot apply Black-Scholes because it is linked to a condition that if the company attains 3% EBITDA, in that case, the management gets certain rights. Now, ESOPs, so it can be performance stock options or it can be ESOPs. Okay. How many would you any of you have actually done that? ESOPs valuation?
I've just heard about it. There was an assignment, but they were like कि Big Four चाहिए.
हाँ, वो उसमें they actually try because the Big Four or someone who has done it, who has handled Big Four in the past. So we do a lot of this Monte Carlo also. In that case, what happens is that there are simulations which need to be done and the drift, etc. All of that story is there. Why? When is this important? Because there are a lot of uncertainties. Let's say 3% EBITDA. So today the startup is in negative zone. What is the likelihood that in 3 years it will go to a positive 3% EBITDA zone? This is a very high differentiator thing, Monte Carlo simulation. So for example, if the stock price today is $3, if the stock price becomes $4, then this becomes exercisable. So theoretically, what can you do to estimate the probability that this will become $4? What will be probability? So let's say the company is listed on New York Stock Exchange. Currently, the share price is $3, and the employee will get these options only if the share price crosses $4. Then what? How will you account for the cost? Any logic? Means if the share price is 3 today, what is the likelihood that it will become $4 in 3 years from now?
We can do
Yep.
based on the growth rate by which the company is,
Actually, not growth rate, volatility.
yeah, sorry, volatility, not growth rate. Sorry. My bad.
It will not be growth rate because it is not that it has to necessarily grow, no? It can fall also. So therefore, volatility is the right number that will be plugged in. And on that volatility, then you can do simulations. 10,000, 20,000 simulations. Ki, acha, if this is the volatility and this is the base price, once I run the model, in 35% situations, it has crossed $4. The moment it crosses $4, it means that the option will be in the money. So that employee will get this options at $3. $1 is the payoff. And then in today's value, you will get the present value of that. And the company has to account for 35% of that cost. So that's the style in which that gets done. So what happens here is that, so that is okay. Monte Carlo is very exotic. Only very few companies have it. And out of that also very limited companies will give it to people like us because it is a preserve of the large firms. That's a reality. Okay, what to do? So there are in the model, you have an spot price, exercise price, RF, volatility, and time to maturity. Okay.
Then
So
how we
now,
will learn? If we are not getting the work, how we will learn?
okay, I mean, that discussion is very different.
Yes, I know.
Difficult.
Khushbu,
Then
it's very easy. We will first time we will connect with Mr. Anurag Singal, do it
Yes, we have
collaboration.
to.
Then we will do it separately.
No, it is not given only. I mean, I also don't get. So that is also one challenge often. But okay, I sometimes say, okay, I don't run oil refinery also like Ambani. So okay, that's fine. Everything we cannot do in the world. Whatever we get, we should do. So now spot price. So there are these 5 points of discussion. And in the course of practical deliberations, through the fighting with the auditors, etc., this also has a lot of stories. Now, what happens is that as far as the spot price of the option is concerned, okay. So, what do you take as a spot price? This 100 rupees. So let's keep it there only. The company has granted options throughout the year, 1st April 24 to 31st March 25. And it has happened every month. There have been grants. The standard says as on the grade of grant. In that case, how do you get the fair value as on the date of grant? During the year, there are 25 times where grants have happened. What do you do?
See, we take near to the date of grant, okay, and also we take the comfort of the auditors and the management here. See, we take a practical call here, okay. Say like it is say June 30th is the grant date. So, like we can take April if you have done DCF or thing. Of course, listed company will have a comparable. Unlisted company, every quarter you do a valuation, same thing you do, use as the spot price. Though actually you should use on the grant date, but for practicality to work on in a month if there are 10 grants, we can't be doing for the whole month 10 times. Okay. So I think we do it quarterly, but we take the comfort of the auditors in whatever
Quarterly
aspect.
may what happens? For example, let's say in this situation in October 23, the company had raised Series B at 6,200 rupees per share, and October 24, it has raised Series C at 7,800 rupees per share. And then in Feb 25, it has raised another round at 7,900. Basic same, almost the same round. Now what do? You have grants are from April 24 to March 25.
No, October alone, I will not follow that averaging. Means I'll do before one.
So can you take 6,200? Should you take 7,200? So basically, the share price was 6,200 in October 23 and became 7,800 in October 24. Your grants have happened from April onwards, right?
Anurag ji,
April, May, June, July. Yes.
I have one point. As you said, ESOP is a very complex model. Only 15% of the people are only able to do. We are also coming on 15%. You are asking a very tough question. Can you just complete one basic model and then we come to the practical challenges?
No.
See,
No, he's making us to think and then.
No,
It is
what
very
I'm saying is,
simple.
no. What I'm saying is,
That
first of all, we don't get assignment. If we get private limited company, only one grant. So if we can comfort, then we can. You are talking about complex models.
this is not complex. Complex I will not teach. No, this is very simple. Logically, you have to think.
This
No.
is practical question which
This
everyone.
is common in all the startup
Yeah.
ESOP. This kind of
Yeah.
model, what Anurag is trying to tell us.
This is very, very simple. That there is a precedent. This is a level 1 input 6,200 and 7,800, but that is in October 23 and this is in October 24. We have to start from April, May, June, July, August, September, October. So after October, I think life is simple. October, the fundraise has happened. So from October, you can take 7,800. Okay, till Jan. And from Feb, let's say you can take 7,900. Now here one challenge comes. For April to September, should you take 6,200, which was the last one? Or should you think that I am extrapolating that the price did not suddenly move? So it did not jump like this. It jumped slowly. So it is 6,200, 6,400, 6,600, 6,800, 7,200 like that.
So Anurag, generally we need to do valuation as on April 24. So first we need to find out what is the value of the company as on April 24. And
What will you do
this
that? Will you apply some linearity here? October 23
So, sir,
say yes.
Yeah, Anurag, please go ahead. You were saying something.
So what will you do that? The first April 24, what will you take as the, so 6,200 is there, 7,800 is there. Will you take some proportionate growth that there is a delta of 1,600 across 1 year and hence in half year it is 800. So the midpoint is 7,000. Is that the right option?
See, you will do a valuation, fresh valuation.
Sir, actually I will do a valuation as on April 24 and based on that value, I will do this BSM.
But what will be the end value of that? What will be the logical output of your DCF? So DCF is a servant. It can give whatever result that you want.
Correct.
Will it be 7,000? Will it be 6,200?
It should be 200 and 7,800 basically. Ideally, it should be if the company is in the normal course of normal running of business.
Ideally, above 7,800.
No, 7,800 from October onwards is okay. I am talking about here.
Before
that.
April 24 you're talking.
Yes. 1st April 24, what should be the fair value as per your DCF?
It should be between 6,200 and 7,800.
7,000. 7,000.
It should be 7,000. Yes. So a lot of people will take that practical view that the price has grown proportionately between October and hence midpoint is 7,000. That is the practical thing.
One small query. When we are doing the valuation at 1st April 24, how do we know that in October 24 the price will be 7,800?
Now you know, na Baba.
Okay.
You are doing the valuation now after March 25.
Okay.
So because of that.
So
normally we get this valuation around this time, July.
You'll get around, this is the season. Na? April, say September is the season where you can do this. So by this time, both rounds have happened. And now you have to do the accounting. So you know that, okay, there are two L1 inputs, 6200 and 7800. As on 1st April, ideally you should come at around 7000. Now your DCF, so okay, DCF, whatever you punch in, it is garbage in, garbage out. So
No,
are we on the same page, or do you have any different opinion on this?
no. How should we put across this in the report? See, one is the transaction price, and sometimes you do the DCF. So, as a valuer, how would you?
The DCF eventually should convert around 7000.
No, but see, sometimes you are taking the transaction price. Sometimes you are doing the valuation. Okay.
But that valuation is not like, it is not a circle rate that you have to download from a website. That 7000 or 6500, you have that flexibility of maneuvering around it. No.
Correct. No, but like in the assumptions, like how we have arrived, should we make it very clear? Okay, we have relied on this round of funding. We have taken this as the current
No,
spot.
you cannot say. So technically, DCF is an independent exercise,
Okay.
but the end result should converge somewhere around this. That's the thing.
Okay. Fine. Thank you.
Sir,
So what is the final conclusion of the spot price here?
yes,
Each
ma'am.
point has
Midpoint.
Sir, midpoint, it is again coming to a subjectivity. See, in
It
between,
is subjective.
it is purely a subjectivity and very difficult to convince the auditors, and it has
No.
got
Auditors get convinced. That is the most logical thing. The midpoint is the most logical thing, because otherwise, if it is 6200 and 7800, what is there in the middle? You can, again, otherwise it will be endless. Again, it is depending on the auditor's comfort. But yes.
And sir, further for the fair value disclosures under Ind AS 102,
Hmm.
even though over the period it has been granted, see, now we are talking about only in a year, but outstanding ESOPs will be there over the years. Let's say it may be past 2 years or 3 years maximum. It will not go, because by the time are in the unlisted companies, it will be like even 5 6 years also, as we discussed, they won't exercise at all, but we would have finished the accounting for that considering the vesting period, ignoring the whether they exercise or not. That's what the many of us we doing, because that depends on their cash flow situation or the many of the triggering events by black school model. But when it comes to the true up and the end of the years, we have been asked to find the fair value for all the things by considering the year end date. That is what the we get the request is.
Actually, in
This is the
listed
fair
companies, they
value
give
of the
RSU.
company. Yeah, this is the fair value of the company as on 31st March 2025. Now 31st March 2025. These are the vested and the unvested options. You please consider the fair value and give us the ESOP valuation for the graded vesting. Is that process wrong or what? Because you said
No, there is
only.
no question of true up there. Actually, whenever it is granted at that point of time, let's say the listed company share price was 600.
Okay.
Later it became 1800. You are not supposed to true that up. So that is what I started at the beginning. A lot of people have this confusion that when I granted, it's a listed company. It is evident that the price was 600. Today, March 25, it has become 1800. So whatever are the outstanding options over the year, they should all be marked to market. In that case, this is not like a forex contract that it has to be marked to market and routed through PNL. It is the date of grant, whatever is the grant happened, that's it. That's good enough.
Okay, even for fair value determination under 102 as well.
Yes. Listed
Got it.
companies, maybe this is there. This is a
Oh,
big area of confusion for people whether that true up should happen or not, but there's no true up that is required.
then in case when there are 10-20 grants over the 2 years, we should have the 20 working graded vesting
Yes,
methodology.
you do
Because
that.
once granted, your fair that spot price remains the same. We in fact need not require the calculation once again. Once the
No.
grant time
Once the grant is done. Grant is done, you have to do the accounting. Once later, only the ones who are exited, you cancel those options, and therefore the cumulative cost to be recognized, you reduce. That's it.
Then why Big Fours every year is asking give us the fair value determination for the ESOPs, follow the Black Scholes model, and I didn't understand if that is
For
the
the
case.
grants during the year.
No, full they ask for all the grants. We make it revise the based on the fair value that whatever the valuation report we get, and then ESOP's fair value will give
Yeah,
it.
wanting a true up.
Yeah, no, they don't. They consider it true up or not. I'm not sure, but we'll give the entire value revised working with the latest price as of 31st March 25.
Acha, it has happened. I will discuss with you offline, trying to
No
understand what
problem.
happened is that.
No problem. No.
Yeah, Mr. Anurag, my request is, can you please take the questions in the end so that the flow of the session is taken
Yeah,
care?
correct.
Yes. Correct.
Exercise price, there is no ambiguity here because exercise price is as per the grant letter. So that you have to simply take it from here. RF. Now RF may there can be continuously compounded rate also, which is a zero coupon bond continuously compounded. But please remember here only one technicality which comes is that continuously compounded rate which is there has to be coterminous with the life of the option. So a lot of people think that RF means 10-year GSEC. Isn't it? A lot of people have that conception now that risk-free rate of return means take a 10-year GSEC.
Yes,
But
yes.
that is not the correct thing because it has to be coterminous. It has to coincide with the life of the option. So for example, if the weighted average option life is 3 years, then you have to actually take a 3-year bond and take the rate at which the YTM at which the 3-year bond has compounded. So basically, when you talk about continuous compounding, you're talking about YTM. So this will be a complexity which some very big four auditors will insist on all of this YTM and all. Normal people just take 10-year GSEC and move ahead with life. So to get that 20,000-25,000 rupees assignment, so you should do like that one. You should not really fret over it so much. So that is risk-free rate of return. Now, if it is Singapore-based company, then what will happen? You have to take the risk-free rate of India or Singapore. So for example, if it is an Indian operating company, employees are in India, but the shares that are granted are of the Singapore holdco. In that case, which risk-free rate of return will you take? Singapore ka risk-free rate of return or India ka? Indian company will book the accounting cost in its books of accounts. You understanding the complexity here?
How does it matter? The shares is of Singapore entity. Then it works on the Singapore basis, no?
No, but the operating company is of India. This is one confusion which happens. It is an Indian company, which is an operating company. The shares are of Singapore entity, which is a holdco, which is just an empty holdco in which funds have been raised.
Any volatility or anything is associated with the macroeconomic factors of Singapore. Being in
It
India
will not be
doesn't
India,
change the
because
way. Yeah,
it will be Singapore or India.
it will be Singapore.
Singapore. Yes. So that confusion should not be there. So even if the employee is situated out of USA, still it will be Singapore, because this is the share, the country in which this share is, holdco is of Singapore. So volatility will be of Singapore. That is that. Now, how do you compute volatility? Whether you take Ashwath Damodar and AD and just be happy, whether you take peers. Now, taking peers can be quite a challenge. There could be no right peer. For example, there was this company which Cryzek recently did an IPO. It is into education abroad. Now, what do you do for education abroad? There is, I think, one company which is listed. Otherwise, what do you do? So, volatility can be Ashwath Damodar, but the moment you use Ashwath Damodar, then people say, "Arey, he's a lazy valuer. He has just used Ashwath Damodar." If you try to get it from peers, that is more logical, but then that makes it more subjective also. For example, we were doing it for a cyber security company. Now, in case of cyber security company in India, what is the listed peer? Quick Heal. But then you can also take a lot of cybersecurity companies in the US also, which are unlisted. So from that perspective, access to some sort of data sets is good if we have. Then that makes the report more logical. So volatility is one question that needs to be addressed. The last question that needs to be addressed is time to maturity. Now this time to maturity will be min plus max by 2 that we have discussed. This is logical. So that max, you have to look at it from the grant letter, that after vesting happens, is it like I have to exercise it immediately and it will lapse, or it can be after 10 years and it will lapse. Usme bhi conditions are there that if the exit happens, still it is alive. In some cases, it is the exit happens, you have to immediately grant. In that case, the attrition and all also can be taken into consideration. Ki, okay, so much of our things have happened. So this time to maturity is very important, because in one of the discussions, what happened was that the higher the T, the more will be the volatility, more will be the fair value of the option that will come. If you put it in a Black-Scholes model, moment you put more T, the more the time to maturity will come. Company will say my employees in the past have exercised options as soon as they have vested, and hence you take a lower T because my cost will be lower. So in that case, you have to try to see. I mean, that is one practical situation which came very recently. The company said, boss, I can't take T equals to 7-8 years, because that is going to make a major hit on my PNL. I have to take T as 2.5 years. And they gave history of the past, that exercise happened, and because the company is so lucrative, it is growing so fast, it is able to, the employees exercise it even after paying taxes. So this is one practicality. Okay. So what will happen if the current price increases, the fair value of the option will increase. If the strike price increase, of course, it is inversely proportional. Volatility, the more the volatility, the more will be the fair value of the option. If you consider dividend, now should you consider dividend in the case of a startup or make it 0?
0, 0.
Zero.
But
Zero.
if it's a listed company, what should you do?
Based on past. What
No,
they have
no,
given the
dividend
dividend.
rate, dividend rate. The
That is what I'm
dividend rate
telling
can
you.
be two things. The company says I've declared 100% dividend. Will you take 100% in the model? Listed companies, they will say like that, I've declared 350% dividend.
But it is based on the face value. Na? When you are talking about the percentage, it has to be on a face
So
value.
then what you should do? You have to take something called dividend yield.
Yeah, dividend yield. Yeah.
You have to talk about dividend yield, which will be, let's say, maybe 2% or 1%. It will be almost like that only. Okay.
Yeah.
Then time to maturity, directly proportional, and RF. We have discussed all of this. So the Black-Scholes model is very simple. ND1 ST minus ND2 ST2. That you can put it in this. So for the uninitiated, the terms of the agreement is grant is 22, vesting start is 24, contractual expiration is 24, fair market value as on the grant it is 100, and exercise price is 57. So in that case, what will happen is FMV as per Black-Scholes 57, spot price is 100, time to maturity 2 years, RF 6.8, 2-year GSEC bond. Please remember, because the time to maturity is 2 year, average of vesting and contractual term. So here the contractual expiration happened at +0. So it is 2 years. That is min. Max is how much? 2 years. Please understand this. This is a very fine technicality, that it has to be 2 years and 2 years only. In this
Anurag,
case,
here we can also take weighted average life of options, no? So assuming it's
here
for
it is
2
just
years.
one. It is just one. No,
Here
in
it
this
is
case.
just one. Yeah.
Then you have to take weighted average. But here the contractual expiration is, boss, vesting hua, if you don't exercise, gone.
Yes.
But in some cases, it can be 10 years.
Yeah.
Vesting ho gaya, you can, it will remain alive for 10 years. In that case, what will be the T that you will take? It will be 2 plus 10 by 2 is equal to 6 years. How will that impact the fair value of the option? It will increase the fair value.
No, even in case where they wait for a liquidity event, say like the company is planning for a liquidity event after like say 12 months, okay, you have become eligible to exercise the option. In those cases, you just consider the liquidity event, or should we apply this averaging? Because
No, yes, that is what I was just saying. In some cases, a company is able to demonstrate that it has historically always given a liquidity event.
okay.
This 2 we have added for the between grant and vesting date, the 2 years. 2 plus 10.
Yes. So grant, the cost is recognized on the grant date. The min is the grant minus vesting 2 years. Max is, oh, actually, max will be 12, not 2. Sorry. It will be 2 plus 12 by 2 is 7 years, not 6 years. So the best is min plus.
What is 12 here? Like
What is
2 plus
12?
12. Yeah.
Suppose if the contractual expiration in this case would have been plus 10 years. So it would
No,
be
in the present,
1
in the present case, 2 only, no?
in the present case, it is contractual expiration is so it is plus 0. So it is min plus the life divided by 2. So in this case, it is 0. So it will be min only 2 years only. 2 plus 0 by 2 is 2 years.
2 plus
Okay.
0 by 2 is 1, no?
No, 2, 2 plus 0 by 2.
Oh, acha.
2
In
plus
the
0 by
example
2.
of 10 years, what Mr. Anurag has considered, the employee has 10 years time to exercise his.
Option.
Yes.
That was an example.
In that
Extra-
case, the time period will be 2 plus 10 by 2 is equal to 7 years.
Look, in this case, FMV 100 is a fair value calculated as on 31st March 2022, correct?
Yes.
Okay. This risk free we have taken 2 years, because there is a
Yes.
2 years, this vesting
Life
is 2
is 2
years.
years. Yes.
The implied warranty, we need to calculate 40% based on the peers.
Which one? Implied volatility, yes. Or if the company is listed, best is just run that volatility on its own thing.
No,
That
should
formula
we-
you have na LN.
Yeah. No,
LN
but how do
Singal
you
by
map to the
T0.
life of the option, that volatility? Like say, like listed peers, we are having, like it is listed only in say 2021, only 5 years volatility I can find out. Okay.
That practicality it comes.
Yeah. So should we like some the life of the option is 8 years, whereas I am having the data for this volatility of listed peers for only 6 years, especially in case of new startups. Like something like a Zomato or thing I've seen, like a few assignments. I am not getting a equivalent period for comparison. So then should we say like
Best
take
possible
average?
alternative is 5 years. In that case, 5 years. Or you go for overseas if there is something like that. Or try to extrapolate that, okay, if the volatility of Jubilant Foods will be this much. So you can take like that also.
Okay, we can explain. Okay.
You can try to say that, okay, food delivery, say only 5 years data I have. Proxy for food delivery is a restaurant business or food chain like Domino's or Pizza Hut. So Devyani International and all of this I can take. Burger King and all like that. Thoda sa you have to fight. I mean, this is a thoda sa auditors also feel na the moment they see a small guy doing the valuation, na their blood gets excited. Hello, let me screw him up.
Okay.
No, this what we got 50 rupees is 1 minute. What we got 50 rupees is an option price, correct?
Yes. This is a call value. Now that call
okay.
value has to be amortized as per graded vesting method over the next 2 years for that train. So 50 rupees has to be there first. So let's say 4 months fall in this year and remaining months fall in the next year. So then only 4 months cost you have to take 4 by 48.
Next year, 12 months.
Yes. So for example, if there are 25% in each year hai, so it will be 4 by 48, 4 by 36, 4 by 24 and 4 by 12 like that.
Okay. Suppose if this option is this is same instead of 2, it is a 5 year. First year I'll do. Next year when you go for it, this option value I need to recalculate, no? Second year?
No.
Then how do I don't know. Fundamentally, I
It
may be
will always
wrong.
be as on the date of grant. That is the whole challenge. Na? A lot of people feel that every year you have to recalculate.
That is a big
Always you have to
challenge.
go back to the date of grant.
So it means that once you calculated this
This
option
is
value,
frozen. Yeah, this is frozen. Yes. This
So
is
for
frozen.
every year only just accounting entry.
That amortization is there. Attrition if changes, then so the cumulative cost to be recognized can change because there is now more volatility in that company.
Okay. Sorry, I'm repeating. It means that valuation report is obtained and the date of the grant is frozen.
Yes.
Apportionment of cost depends upon number
The
of
time
months.
period.
If the any change in the cumulative attrition rate, we need to adjust for the cumulative minus the balance period.
Yes, yes, yes.
We are
Absolutely.
thinking.
Thank God.
Okay.
This is exactly the right definition here.
I
Sir,
think I had a different opinion. Good. Thank you.
sir, for volatility also, to determine the volatility for the period will match to the vesting period. Is that so? Because
2 years now. You see, I have taken historical prices of peer companies for 2 years. Yes. Here, if it is 2 years, it will be 2 years.
okay.
No questions for? Okay. So this is Black School's very simple from that perspective. You have now some 20,000-30,000 rupees in the bank. You can feel happy and sign the next report. Now binomial model is there. But actually ESOP valuation pricing has gone very significantly down. People now are expecting 15,000, 20,000 rupees rates also.
Yes.
Because of more people that have come in the market.
But how it is possible? First, we need there are two assignment. One is fair value plus ESOP price. So it is
Accounting.
a 1+1.
But people are expecting and people are giving what to do. That is the market.
Demand and supply. More valuers are there who are doing. So they are like कि तुम नहीं करोगे कोई और करेगा. So they are not
It is a
bothered.
commodity.
Yeah.
No, but it should not be quality should not be compromised. As you said, from 100 valuers are there, 15% are doing the ESOP valuation, and how many do everybody doing? What about the quality?
50 are doing ESOP valuation, but 15 can handle ESOP where Big Six is involved.
Yeah, correct.
So there you will have it's not that because for example, just a digression, but registered valuer reports for that matter, it is such that if you don't pick the phone, they call someone else. If you call back, he said, "Oh, sorry, I had called." Only 15 minutes. If you don't pick the phone, they say it is gone to someone else.
15
Sorry.
minutes, 5 minutes. You are on another call and the work is gone. You are somewhere or you are anything. 5 minutes में किसी और के पास काम जाके execute हो गया है.
हाँ वो थोड़ा सा चैलेंज है
ये
दैट इज
सबके
व्हाई
साथ होता है.
हाँ वो अब कितना कॉल सेंटर खोले मतलब दैट इज आल्सो वन चैलेंज बट दैट्स द होल थिंग ऑफ being in a commodity market. But moment let's say the company wanted a binomial model or a Monte Carlo simulation, it was not that okay they can call up any random guy and get it done, or the auditor is GT, then they know now they cannot call. So therefore the idea should be to build competencies such that you can handle GT, you can handle Deloitte and all, and very much flaunt that okay I can do that.
So Anurag, in one of my cases where I was doing a valuation for ESOP, so for first 2 years I have done the valuation. For third year there was some another valuer. The auditor has asked so many questions. Then the client is telling me कि boss आप ही कर दो ये.
Correct.
It happens.
And in that case, the auditor was Big Four actually, Deloitte.
Deloitte होने से that Deloitte even any मतलब Deloitte, PwC, EY, KPMG, all of them are same stories. 22-year-old CFA L1 will come and he will screw up.
Correct.
This thing है whatever. Now binomial model, what happens is let's say the terms of the agreement is the stock price is 110 today, the strike price is 100, the time to maturity is 2 years, RF is 5%, volatility is 20%, dividend yield is 0%, and DT, which is basically the time, number of steps is 2. So what can happen here is that there is the up factor and the down factor which is there. Up factor, so basically if it is at 110 today, what can happen? It can either move to 134.5 or based on volatility and all, or it can fall down to 90.06. Okay. Again, from 134.35, it can move to 164.1 or it can fall back to 110. And here again, it can move to 110 or it can fall to 73.74. So in such cases, what you have to do is that you have to find the fair value of the option. So there are 3 trains which have come. This is 1, this is 2, this is 3. So if it is 164.1, it becomes here. If it is 10, it is there. And if it is this 73, then it should be negative. Oh, so I'm so sorry. My intern has made a mistake here. She has plotted 0. This is a mistake, no? Fair value is negative because
Fair value cannot be negative, so it will be just 0.
Arey wah, that is intelligent. You deserve a chocolate here. Neeraj, please give her a chocolate. The fair value of anything cannot be negative. It is just that the employee will allow that option to lapse. He is not going to pay from the pocket. So it is not minus 26 will not be there. It will be 0. And therefore, then you have to apply for adjustment, that what is the probability for upside, what is the probability for downside, and look at the probability adjusted cost, discount them to today's value into a single value, that is this 23 rupees 76 paisa is the present value of this option. Okay, so in some cases binomial comes. I have not seen it being done so much. MCS comes in a lot of time. So what happens is that it is a statistical thing where you simulate a range of possible options, share price estimate. And if you have not done that and you want to do it, one very good method is to go to GPT and say that, okay, my company has a stock price of 3, and I can show you, it can do that very beautifully.
Yeah.
GPT makes me worried about my kids, that what will happen. But okay, I am a valuer for a company. I have to perform Monte Carlo simulation. The volatility is of stock is 30%. Current price of stock is. I'm just trying. I have also not tried because there is we have a model here, but I'm just trying to see current price of the stock is 100. The option is exercisable if price after 2 years becomes 150. Can you perform MCS and give me the probability that price of the stock will cross 150? So volatility 30%, current price 100 time 2, barrier 150, assuming a risk neutral drift is equal to 0. So analytical approach, by using Black-Scholes terminal distribution, this can happen. So analytically nearly 12% probability. Or otherwise, so here they have done a very basic calculation using this formula, and they have come that there's a 12% probability that this stock will move 150. So that is the barrier here. The current price is 100, the barrier is 150. In 2 years of time, assuming if the volatility is 30% and the risk neutral drift is 0, or you can share risk-free rate of return for exact modeling. So I can say that, okay, risk-free rate is 7%. The critical Z they calculate. So probability now becomes 20.1C. Earlier, what was the probability that was showing? 12.2. So Monte Carlo simulation with 1 lakh iterations estimate that there's a 12% probability that the stock price will cross 150 after 2 years, given 30% volatility and initial price of 100 under log normal assumptions. And if you do risk-free rate of 7%, you will refine your simulation for your valuable report. Analytical property becomes this. Now this is a Python code, but okay, we'll run it later. When you run this, you will almost get the same number. I think I will not run it. I don't know whether it will. I have Python installed, but may not run. So let's leave it. You were
So
able to
in
see the
Monte
screen, right?
Carlo also, in Black
Were you
Shoes
able to
also
see the screen
same.
in ChatGPT?
Yeah.
Yeah,
We
yeah,
all saw
okay.
it.
Yeah, yeah, okay.
In according to the ChatGPT example, Monte Carlo as well as Black Shoes both gave a similar answer. Huh?
No, not at all. Black Skulls is not applicable in this case. Here you don't have any such conditions. Here the condition is, boss, today the stock is 100. If it crosses 150 after 2 years, which is the barrier of 150, then the option will be exercisable. So here you have to calculate the probability. So it's a 12% probability that will happen.
How reliable is this?
Very much reliable. But again, you can't submit it. So actually you have to run Python here. And I have an MCS model.
So
You
you
can
should
see.
you should learn Python too.
Or Excel, is it possible?
Simulation is possible in Excel. It is a very complex model that runs MCS model. It will not open only. It is a 44 MB file. Becomes a very huge thing. If it opens, I will show you. Okay, if it
Anurag, you can
opens.
share with us.
Sure.
Mr. Anurag, just out of curiosity, say that, okay, what are the concepts that when you say, I'm just asking the underlying assumptions for a Monte Carlo.
Yes.
You say that the time to volatility, the time to expiry can change. If that
No,
changes,
time to
what is the
expiry will not
impact?
change. The
Oh, sorry,
expected
time to
exercise.
expiry will not. No, expected exercise will change. No, how does it expected exercise will change?
So what
You
happens
say that.
is that basically the condition is that 25% of the stocks will get exercised at 2.75, 25% at 3.25, 3.75, and 4.25. There are total 10,25,000 PSUs. So
Okay.
now you have
Okay.
to understand.
Okay. So that
This
means
is the
the
stock price you have to
possibility.
populate.
Okay. So you also construct a similar. Okay, this is for a circumstance where they say that the performance stock in units can get on certain stage trigger. If you
Yes.
achieve this, then it will happen.
You don't
If
achieve
you
anything.
achieve
If the
this, it
stock
will.
price you are the CEO of the
Moves.
company, the
So
stock price
it's
moves.
then I get. Okay, so this is one assumption undergoing a change, which can result different number of alterations, right?
Volatility will make a major difference here.
Apart from, so you will have
RF will make a major difference.
Exactly. So you will have all those working, three different variables changing, resulting in the stock price going either way.
Yes. So therefore you have this probability 21%, 14%, 9%, and 6%. The probability is lowest for the stock price crossing $4.25 and highest for it crossing $2.75. And accordingly expected to vest. So this will be the cost. This will be the value per unit if it becomes in the money in present value. And therefore the total value will be this into this. Okay, and how will the expense amount come? You have to do transpose. It's a big story. So from here, you have to do all this simulation. See, so what happens is the simulation comes here that 20 days prior to this, you have to feed in the model that what was the stock price history. Think of it, it is just languishing in $1.5 ka range. From there, you extrapolate this for the next 1400 days. And therefore, you say that, okay, if this triggers, what will be the share price on the trigger date? Now you are only saying that only such cases please show where it crosses the threshold of 2.75. So this is 000. Why? Because that crossover has not happened. Only in such cases crossover has happened. What will be the value received comes, total value comes, and therefore the present value of the option as well the trigger date comes. Basic concept did you understand? You don't have to do it only.
Yes. Yeah. Because after that, it is only a formula and then Excel will do it for you.
Yeah. But basic concept is that it simulates based on this. Only in some cases where the trigger happens that it is crossing the thresholds, this number will come and accordingly the Excel sheet will calculate the probability for you, and that will come here 21%, 14%, 9%, 6% like that. Okay. Very interesting.
Then you pick up the most probable event and pick up the value of the option, is it?
No, not the most probable event. Here the condition was 2.75, 3.25, 3.75, 4.25. These were the four trigger points on the basis of which if the company share price crosses this, the option becomes accessible.
Sizable. Okay.
So in that case, the employee has a particular reward the moment he
Reward
exercises
value.
the option.
Yes.
So that multiplied by the probability of that crossover happening will be my thing.
Okay.
So it's like that.
That multiplied by a probability of
Probability,
the crossover that it
which
might
my
happen.
system
Okay.
calculated the probability now. Here
Understood.
if you see, the system calculated that okay, 4.25, the lowest probability of crossover was there. 2.75, still there was a higher probability, like that. So here you see 2.75 crossing was 21%. I'm just zooming it a bit so that you can see. Are you able to see it now?
Yes.
If the trigger point was 2.75, expected to vest is 21%. Because that is the probability that it will cross at least $2.75. But $3.25, the probability is 14%. Here it is 9% and here it is only 6%. Clear? Okay. Any questions so far? This was very heavyweight, heavy lifting kind of a thing, MCS. But it will come only once in a while. Normally, it is not really worth it because it might seem very lucrative, but to get this audited by Big Four and all those young 22-year-old folks becomes a big challenge. You can sign off 5 RB reports in that much time and make that money. Well, if money earning is an objective, if intellectual simulation is an objective, that's a separate thing. But that we have done, okay? Now, graded vesting. And then OPM backsolve a bit and then this.
Whether all of this is available in the CFA material?
Pata nahi, I have not seen. I don't know. I borrowed it for this session from someone.
I think we have to
Then I
refer some
mugged up.
other publications,
Huh?
Shilpa. I don't think it's available from the same material. We have to refer from publishers.
I actually borrowed it from someone, then I mugged up the speech and I'm giving the speech. I have myself not done it much.
No, but very
So
excellent.
Shilpa, now we had the benefit of having ChatGPT do all this work. It will give you all research material. You go to Perplexity otherwise, then it will take class for you. That is the best way you do it now. Not even YouTube videos.
Perplexity is rather better, I feel, it has got
It will
legal.
also give you,
things.
it'll, see, we have done, what we have realized is that ChatGPT is more for learning as a tool. Perplexity, use it for if you do a very immersive advisory where you want to know the source document, read it and all that. Because it doesn't, Perplexity reads advisory much better than a ChatGPT. It gives a very immersive advisory. Yeah. So what we do, we generally what we insist, because ChatGPT, when you process legal interpretations, it gives Perplexity gives you an answer, ChatGPT gives a different answer. So for legal opinion or anything specific on a regulation, we try to understand which is overseas or something like that. We generally pick up Perplexity with a link for source and go validate again the source.
Oh,
You
in
can
the
also
Perplexity,
use
we'll get a
Claude.
links, is it?
Sorry?
In the Perplexity,
I
we'll
think
get a
you
source
can
link
also use
also.
Claude.
I have two
please go.
people talking.
Yeah, please go ahead.
You can also use Claude.
Okay. That I have not tried. I was recommended that. So I'm yet to try for Claude. I'm yet to try. I will do that.
Claude, it will be
Let's
more
see.
professional.
Is it? Okay.
Extremely
Let's
professional.
put the same thing in Perplexity, okay? And see what is the answer. Stock price is 100, volatility 0.3, time horizon 2 years, threshold price 150, drift not mentioned. So this. 12.1. What did ChatGPT say? 12.2. ठीक है, it is the same result only. Free ChatGPT Jindabad.
Claude is also free?
Claude is also free.
Claude is also free. Acha. Okay.
Up
Matlab
to
So now
some
if
extent it
for
is
some,
free, but yeah,
for some extent
I
it is
learned
free
the
and then it
lawyers
is
are
chargeable.
using this paid version of Claude.
So even lawyers, councils, big fours are also using it.
Yes,
What is
yes.
the CLOD? Cloud?
CLAUDE.
CLAUD.
Claude.in.
yeah, Claude is also there. If now we put 7% and we do the step-by-step calculation, the probability is 20.1. This guy also gives 20.1.
Almost same, yeah.
All point same. And the same thing you
I
can
said
put in.
interpretation.
I
Mathematics
know.
and all, it will
I'm
work the
just trying
same
to
way.
check. So sometimes I wonder that in the paid plan, will they give a better result, etc.
You can't expect the value to move just because of a plan, no?
No. Some people say that they will give better results if it's a paid plan. I don't know, but there's a lot of confusion around this. Here in Claude, what do they do? Let's see. And nowadays the problem is after two questions, they say go for paid plan.
Yes.
So geometric Brownian motion community used in model. So they run this whole thing. I think the answer will be the same, 12.1%. Takes more time actually. It's faster in GPT has in, but Claude does very good writing. So if you have to do some representations and all, that Claude's
Anurag,
writing skills are better.
For this, you should not use Claude. Claude is basically for opinions and
It is good for writing. Written
yeah,
thing
writing.
it
It
is
is
better.
good for writing. Yeah.
Oh, it is now showing that it is 25 to 30%. So Claude has given a different answer. Hey Bhagwan. Okay. So then there's a challenge here. Claude does not give the same answer as what we were thinking.
We should write the source in our report.
Claude, na? No, but I am actually looking for one source where, for example, if I have a company which is into, let's say, e-commerce, D2C, if through this GPT and all, they can pick up all the unlisted transactions that have happened in D2C, that comparable becomes very useful. Because to buy,
But if the thing or information is not publicly available, it will write like that. It is not available. We can't get you.
it will write like that. Because otherwise,
It will
the
write like that. Yeah.
software costs $3,000 per annum, which is the total value of my billing. So,
Which is very high for us also.
so
We can
that's the
10-15 people if we can get like.
Kushbu, the session is getting recorded.
Okay, fine. So Monte Carlo simulation comes. So Monte Carlo simulation we have done. Now what remains is OPM backsolve. So like that you do this you have studied now. So only in cases where the trigger happens 1, 2, 3, 4, it crosses, that will come and you will get the payoff in case of trigger and valuation of options. Okay, so this is clear. Now as per graded vesting method, the one which we were doing now, what will happen is employee ABCD, grant date is this, May, June, July. Okay. Number of options is 300, 500, 900, 700. In that case, the first tranche is 50% and second tranche is 50%. So in the first tranche, what happened? value of ESOP is this. So if let's say the grant date is this, vesting date is this, you have to say that, okay, this falls. So in 12 months like this, then the second grant which happens, 10 months fall in this year and 2 months fall in the next year. 9 months fall in this year, 3 months fall in the next year. And accordingly, the whole cost you can apportion in 22, 23, 23, 24, like that, you can apportion the total cost here. So this is the number of options that are vested. You can say that, okay, on a linear basis, 11 months here, 1 month here, 10 months here, 2 months here. So accordingly, the options vested will be 92 here, 8 here, like that. And therefore, if you apply this whole thing, the total options, the total cost becomes 4583,517, like that. And therefore, your total cost will be 58570 for FY 22-23, which is the total 58750. You adjust this for attrition. For the next year, the total cost will be this cost plus this cost. So this is the total cost, and attrition adjusted is 34,000. Like that, you have to do the calculation. Okay, so what you have to do is that whole cost for 22-23 you have to calculate, plus 23-24 ka proportionality and 24-25 ka 1/3, something like that. Therefore, it gives accelerated cost in your thing. So that's called graded vesting. Had it been SLN, I would have just taken 22-23 and my life would have been simple. I would have got a lower cost. But since I also have to consider 23-24, so basically what they say is that this grant that will happen in 23-24, the trigger is starting from here. So 11/12 of that cost should be granted exercise in this year. So like that, therefore, the cost that will be charged to the PNL will be higher in the case of graded vesting. That is the only thing. There is no other complexity as compared to SLN, because you only have to simply do the number of options multiplied by the fair value of the options. You will get the total cost. But the apportionment of the cost becomes higher in the case of graded vesting. Any questions on graded vesting?
Anurag, here that grant date will take in different dates, no? But
Yeah.
normally when a scheme starts, if one scheme will have one grant date, no? Will it have what is the grant date in this case? Is
Options
it
grant date, letter date, not the scheme date.
in the
Option
sense
can be granted in April, May, June, July, like that, no?
okay, new employee joins whenever he
Employee
get eligible to
joins.
join.
Yes.
Okay.
Like that. Okay. Now we have done graded vesting. OPM backsolve, we will just do. Yeah. So in case of OPM backsolve, what happens? What is OPM backsolve and what is the context? I mean, even if you were to not do it, which is fair, it is okay. But what is the concept of an OPM backsolve? Option pricing model.
They do it in the situation where there are too many securities with what do you call like a CCPS, CCD. Is it the only circumstance it would come up?
It also depends upon the liquidation preference of each of the category of the securities issued, and
Yes, LP will change. What else? But why is it context relevant to a discussion in case of? No.
This
I
is
think I've
something I have not understood, Mr. Anurag. If you can throw some light, because an OPM backsolve, when you actually do it in case of several liquid items on your cap table, when you run a BSM, you run the BSM with the whole value of the enterprise itself and see how the distribution of the money across different stakeholders is. Now, this concept to use it in an ESOP, I don't know how you practically do it, because an ESOP, each ESOP has a different vesting date and a different time to expiry varies. But when you do an OPM backsolve, it works on a principle that everything, the liquidity event happens in 1 year, for something, it's a constant period, 2 years, 3 years. So for everybody, you assume a period which is constant.
So basically what happens is that the basic idea is that there is a known transaction, but that known transaction has happened for arm's length transaction, which has happened for a, let's say CCPS, Series C. That's my calibration point. But what happens is that I am granting to the employee a plain vanilla option, isn't it?
Correct.
Equity. If the company were to get liquidated, ESOPs will effectively for rank in that cap table at a particular number. Okay, so first the CCPS guy will come and take 4x liquidation preference. Some will take 1.5x liquidation preference. So assuming that if the enterprise value were to be distributed amongst the different class of stocks as call options on them, then you have to solve backward and say that if the CCPS has been issued at 1200 per this, and therefore what is my implied equity value on this thing. So on that distribution waterfall, if the company has raised 1200 rupees pay the CCPS, I will apply that and I will say that, okay, if 1200 is the price of the CCPS, 750 rupees is the implied common stock option. And that common stock is actually given to the employee as part of the ESOP, not the CCPS with a superior liquidation preference and a voting right, etc. So when there is a complex cap table, option-like characteristics of different security classes, OPN gives a market calibrated approach that reflects how different securities participate in the enterprise value. Okay. So what happens in this case is that you can actually do the see, very simple. There is one S corp in the US seeking an ESOP transaction. What is the cap table? There is a debt of $2 million. Preferred stock is 1 lakh shares of $10 liquidation preference. So basically $1 million, and common stock is 5 lakh shares outstanding. Now your known transaction is that the preferred stock issued 6 months ago was at $10 per share to outside investor. Okay. So what you have to do, you have to set up the debt. Debt will come first up to $2 lakh, $2 million. The debt guy is going to take. Then the preferred guy will come and up to 1 lakh shares. The strike price is 2 million. Okay. And then the common stock will come. So it is 2 million. Why? The starting is 2 million. Here this guy will come and take 1 million more. So for the third person, when will the common stock guys get the thing? Only if the company were to be liquidated and you get more than $3 million, then only the common stock will get something. This is logical.
Correct.
So if the company were to get more than $3 million, means if the enterprise value is more than $3 million, then these 5 lakh shares will come and say, boss, give me also something. So then what you'll do, you'll apply the Black-Scholes modern framework. So this is basically you apply the breakpoints. So what happens is that the preferred stock recently was sold at $10 per share. RF was 44%. Time to liquidity event was 3%, 3 years, and estimated volatility was 35 years. So the step for backsolve for enterprise value will be OPM backsolve will be preferred stock option will be $10 into 1 lakh is 1 million using Black-Scholes with preferred as call options struck at $2 million. So implied valuation in this case will be $42 million. And therefore, it goes on and says that my implied stock option will be $950,000 will accrue to the equity in case the overall implied value is 42 lakhs. And therefore, first stock, it will be $1.9. So if the employee gets $150,000, this is what it will be. So basically what it is doing is that common stock will come into the picture only if the first two options are there. So let me just open the other one also. It is just like this. This is a real based company. So what will happen is that there is common stock in the cap table. There is series 1, series B, series C, all of this is there, series A, series B. This is fully paid up, this is partly paid up. So these are the number of shares, these are the average issue price and liquidity preference. Common stock will have no liquidity preference. These guys will have liquidity preference. That if the liquidation were to happen, first I will get. What is the seniority? They are senior, 1 to 1. These are all senior together. ESOP is, then common stock comes and then ESOP comes in terms of preference. Now ESOP at 10 will be more lucrative than ESOP at 66, 560. And therefore in the break point, then you'll have to say that, okay, if they were all to get converted, what will be the conversion ratio, which is also mentioned in the plan, that these are like 1:15. So number of shares post conversion. Then what you do is that you calculate the strike price for call option valuation. That, okay, these are 28,337 shares. Then common stock receives value. Then ESOPs also convert. Then series 1 and series seed 1 and seed 2 series convert. Then series 3 CCPS also converts. Then A, B, C2, C7, and then ESOPs and thereon. So this value comes there. So what we are trying to say is that first, all of these guys which have a superior liquidation preference will participate if the company were to be liquidated. So what will be the break point? Up to this much of the liquidation value, all of which this CCPS gets. If the company were to get sold off at this much value, will other guys get anything? No, they will get nothing.
Nothing.
Then common stock also, guy will also get some value, which is this 10,000 shares. There is no break point here. Now, if the ESOP were to get converted, what will happen? This further 1,508, these guys will also come into the picture. And then they will get this much money. The break point will be this plus this minus this into E17. Okay, so basically that will come at each incremental breakpoint. This will be made. And on that basis, what you say is that, okay, now all classes of folks will get. And then the spot price as per the valuation, this is the implied equity value. And therefore, if all of these were options, series C to C7, series B, series A, series 3, series 1 and B, etc., the value will get split amongst all of this. And accordingly, you'll get the value, floor, cap, and the differential. And therefore, if you further apply a floor coil value, you will get the distribution of the incremental call options. And therefore, the value allocated will be this. For A, it will be this. For here, it will be this. Like that, and divided by the number of shares, it will be like this. Okay. And therefore,
Mr.
this.
Anurag, I have a fundamental doubt. So this OPM backsolve, you do it in the case you have a complex securities on your cap table. Now, this cannot be variant because you assume that within a standard period time, say 3 years or 4 years or within a year. Generally, we do it for the case of 409A valuation where they say within a year, there is likely to be a liquidity event and how the money gets distributed among all stakeholders. Can be 1, 2, you take a management representation, find out what is the likely chance they would raise, what is the runway, etc., and you make a conclusion. Now, this is an ESOP value that you have taken based on what is the final distributed value of equity that you actually get to those ESOP holders. Now, when you actually grant an ESOP, today this is the value of that particular equity if it gets distributed. Now, an ESOP is actually given to you over a period of say 8 years or a 10-year. Okay, so now the time to expiry of this will also change and the volatility will also change, right? Because you're making an OPM BAPSOL based on a certain assumption that the liquidity will happen in 2 years or 3 years, and you have taken an assumed volatility based on that and run an option pricing methodology. Now, this is an ESOP value that you actually received based on an OPM BAPSOL. Now, that ESOP doesn't have a same time tenure as that of an OPM, what you have taken as an assumption in OPM BAPSOL. It actually has a higher tenure. People are not going to vest unless there is a liquidity event. So if I have a management representation saying that in the next 1.5 years, I get the money funding, which will be equal to what I have taken as an assumption in OPM, it makes sense. But you have to also note the fact that some of the ESOP holders will have a cliff. And that by the two-year assumption in an OPM backsolve, that ESOP itself would have been vested at all. There won't be any vesting of those ESOP holders. So this comes almost like a catch-22.
Absolutely. So in
Because-
that case, this is only a broad estimation of the value.
It's a broad estimation. I understand that because you have taken an assumption of a trigger event in the next 1 year and what has been the valuation in the market and what is the likely value a transaction has taken place. So you have two-level broad estimation that you have taken. Now my question is, based on an OPM, you have taken a 2-year. In some cases of those ESOP that I'm valuing today, that what do you call that 2-year mein vesting bhi kuch nahi milega usko. It would have had a cliff.
Because he is
After
restricted by the
48, they would
cliff.
have.
He
Yes,
is
he is restricted by the cliff. So now it is like a catch-22 for me. Now, how
No, but
do I
in
take
such cases, what happens now? The company, in many cases, when the liquidity event comes closer, to make the employees happy, they will
They actually
do
give a
the,
cash settle out.
they'll give even the, they will either do the cancellation, the company will buy back the cancellation of options, or they will amend the ESOP plan retrospectively and give the accelerated vesting.
Which is practically what would happen.
Yeah,
I'm
practically
saying
what will happen.
comes, I would have a 409
Theoretically,
where
you are
I would
stuck.
get a.
In this case, theoretically,
stuck,
you are stuck
yeah.
because technically they are not vested only in that 2-year
Yes.
horizon. So how do you attribute a value to them?
Exactly, because I am actually I am for the purpose of accounting, I am supposed to give a valuation for an ESOP, which where I say that in the next 8 years, the probability that all of them would be vested and then further exercise in probably 5 to 8 years.
Yes.
So my lifetime of that particular option is like 5 to 8 years, whereas in an OPM backsolve, I am sitting with a expiry date of probably 1.5 or 2 years. Now this is like a
This
how
is there,
do you
but
do a
practically
valuation?
companies have been amending their board through a board resolution, the ESOP plan retrospectively they are amending. If in case that actually liquidation thing happens. So theoretical, practically that challenge will be there on the theoretical construct.
Can
For
I actually
sure.
make a reasonable assumption that, okay, this is my ESOP value today, but over an 8-year period term, which I have also seen in the case of a lot of buyback that has happened in those where there have been cancellation and they providing a value. Say, for example, they've given the value at $1 today. In past, wherever they have granted, I'll just make an assumption. In the past, where they have granted it 50 pence, okay, they have subsequently in 3 years, 4 years, they have given them what do you call? They have all excised. They've all got a benefit of a one pound swing, as against the 50 pence in over a 3 or 4 year. Then can't I just run an extrapolation for this option value that I have today over a period of 8 years and say that they might have a higher value and run a BSM on that? What would be wrong with that?
And try actually have not really come across this situation, so not sure.
This is one thing because when we have to pick a 409, it will always be closer to 1 or 2 years.
Yeah.
When the event, but your ESOP you're valuing is in a contrarian, which is a longer period.
That theoretical challenge is there.
We can allow Mr. Anurag to complete his and then take it up.
But I don't have much to show now, only from the disclosure perspective. Another point comes, this is actually the most difficult part for me. The FS disclosure gives certain things, like what are the number of options that are granted. Okay, here there is no concept of weighted average. What is the average option life? So what happens is for each of the grants, like on 1st April 23, because it is 25% in each year, so it is 6, 7, 8, 9, 6, 7, 8, 9. So what happens in such cases is that the weighted average for this will be the total number of options granted and the sum product basically. This is clear. So for each grant, let's say 2nd Jan 24, you have 6, 7, 8, 9, 6, 7, 8, 9 like that. Okay. Now, risk-free rate of return again, because it is 6 years, you take a 6 year. If it is 7 years, it is 7 years. Then again, you can take a weighted average risk-free rate of return, and then you take an average fair market value of the options that have been granted, and it can be this. And how did you get the fair market value of the options? So remaining contractual life also is one question. That weighted average is 6.29. So what happens is the options granted are this. Tenure is 10 years. So vesting is on 27th. Let's say the grant date is 22nd November 2016. The vesting date happens after 10 years. Maximum term is 10 years from the vesting date. Financial statement is drawn on March 24. So what is the remaining contractual life? This minus this by 365. This is as per the max. And therefore this will be the weighted average. So this remaining contractual life also is a disclosure which is important because the companies have to show that, okay, what is the tenure for which on a some product basis, on a weighted average basis, my life of the option that remains is 6.29 years. So this disclosure will also come into the financials, and this also consumes a lot of bandwidth. So in case the company really is on this, so this challenge will be there that these disclosures have to be very bang on. So the Ind AS 102 will disclose you have to disclose the agreements during the reporting period, any settlement method, vesting conditions, weighted average number of shares outstanding at the beginning and granted, vested, exercised, forfeited, average share price of exercised options, range of exercise prices, and remaining contractual life of options outstanding. So, and what was the valuation method? So let's say Black-Scholes method that you applied or intrinsic value method that was applied. Impact on the income statement, that is total expense, and the financial position, that is the carrying amount of liabilities or share-based payment. All of these disclosures are required as per Ind AS 102. So these disclosures also do consume some bandwidth from a practical perspective. So that is how it is. So I am fairly done with my session now, broadly completely over. So happy to answer any questions if you have.
But in Monte Carlo simulation, we worked out the probability. But the formula what you gave, I don't see the probability as an input anywhere in the.
Where in the Monte Carlo?
Yeah.
Yeah. Later we did the accounting, no, on that basis. That if the share price crosses $3.25, then it will be in the money. If it is in the money, this will be the payoff to the person. And if that is the payoff, then what will be the present value of that payoff? We have done that calculation in that. That is when that probability will be used. That is the whole objective of calculating that probability. That what is the probability that it crosses that threshold and all.
Okay.
Yeah.
Thanks.
Yes. Any other questions? Miss Maithili, you do it for US based companies, a lot of these BSMs, OPM, Backsolve and all. What do the auditors say in that case, in case of US companies?
So we do it for the US company. Auditor, so as long as, you not had a big four coming in there for an India side integration and all that. So we've not had so much pushback. But for me, conceptually, I've always had this question. So that is why I asked.
Yeah, this conceptually question is there, which I also raised. Then they said that we are going to do accelerated in case some liquidity event comes.
See, if the management representation happens, it's okay. But I am actually stuck in one particular place where they're having difficulty raising funds in the last 2 years. So to assume a liquidity proposition there is like, we know, boss, whatever you tell, that's not going to happen. You're not going to have a raising money is going to be a challenge. So we've been pushing back saying that no, in that case, the option value would change and it cannot be the what the OPM pulls out. So we say you do an adjustment to it and probably do a BSM on that and work on it is what logical reasoning, because the the value would change over a 8-year period if the whole thing undergoes, volatility, everything would undergo a change.
Absolutely. Okay. You work with Deloitte or something, or you practice?
No, I work as part of a consultancy business in a chartered accountancy firm. I work completely on a consulting side, so I don't have the whole aspect of this accounting standard pushing me everywhere. Just that I know how it applies. So we are also
Sure.
the stat auditor, so we are able to push back there.
Okay.
If
Sure.
I have somebody contrary, I don't mind. But if somebody else comes up, then I'll have to push back and say, okay, tell me what is the Otherwise, the OPM itself will undergo change for each ESOP option. And I'll have to change it for every vesting period. And the beautiful thing these US guys do is that you get that 1/48 and all that. That is a nightmare for me for constructing the whole thing.
Absolutely. So to sum up our session, if anyone were to sum up what you have learned, anyone can volunteer. Spoken endlessly for 2 hours. What have been your key takeaways?
In fact, I will sum it up when I say vote of thanks on behalf of BVA.
Okay, sure.
Anyone else can pitch in?
Main two clarifications what we got is true up and true down is not at all required as per the standards, which is a common myth everyone is following. And then the grant date is the one which everybody has to take for the purpose of the valuations. So this is the key takeaways. Of course, on the process and the knowledge sharing session is well and good, and you try to take it as much as possible on the practical side. That was much appreciated from you, Mr. Anurag.
My takeaway was the linear value for the price that we take. So that was something we had strictly taken only the specific value before the grant date, but linear value was a nice takeaway for us.
Thank you.
Mr. Anurag, when you were sharing your LinkedIn profile, we saw that some 60K followers you have. So any tips you want to give to increase our followers on LinkedIn?
You can buy followers also, and you
My
can.
God. I'm sure I have read some of your posts. They are very interesting. So any tips you would like to share with us?
No, I think you have to just keep writing whatever is of interest, whatever is your area of interest, that you can write, and if you're lucky, people will give some ideas. There's no link as such. So the LinkedIn has also become a very complicated place. You can become part of groups where you say, okay, this is my post. All of you please comment on that post, so that this goes into the feed of all of your friends. And once you post, I will also feed on that. On that basis, people cross exchange and they have grown to 1 lakh, 2 lakh followers like that. Can you beat that? LinkedIn has also become a very dirty place like that. In reality.
Yeah. We have come to the
22-year, 23-year-old youngsters, they take 4,000-5,000 rupees for promoting some collab. Then they go to these groups and say that because you have committed 5,000, 10,000 impressions, then say, please, 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 1 like, because I have been paid, I will do yours. So that's how it comes. Okay.
We have come to the end of the session. On behalf of Bangalore Valuers Association, I'm extremely grateful to today's speaker, Mr. Anurag Singal. It was so nice that we got introduced to many of the new terms like cliff period, accelerated vesting, true up, linear. Everything was really a wonderful session. I personally felt that, a little more work is required from my end to whatever, I could not really understand everything, whatever you have said. Thankfully, if this session is put it on YouTube, by our admin, we will go through once again and, relook at certain aspects which I have not understood thoroughly. And you have touched upon the basics of Black-Scholes, binomial, and Monte Carlo simulations. It was a nice summary of the entire, valuation of options where complex securities are there. Vijay, you would like to share your screen for the momento? On behalf of Bangalore Valuers Association, we should be.
Yeah, I will share my screen now.
Yeah. Our admin will be in touch with you and share a token as a token of gratitude from BVA this memento. Thank you so much, Mr. Anurag. Yes, we are long way to go to reach the way you have shared with us. It's a good inspirational session today. Thank you everyone for participating. Any other announcements, Mr. Neeraj, or anyone from the committee?
Neeraj is there?
This memento you can actually not courier. If you can give me 2 CPRs. It will be more useful because this memento I have 2 I have already on this. So
Sure. We'll definitely.
you give me CPRs, it will
definitely
be
do
more
it.
useful. Huh?
Yes, surely we'll do that.
Okay.
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 Thank you.
Thank you, everyone. Have a happy weekend.
Yeah.
Yeah. Thanks.
Thank you.